Hi, welcome to Market Minute. We're still very positive on biotech. It's been about a year or so since we were pounding the table on biotech. We're still pounding the table. There's really some great opportunities still left in this market. I'm gonna walk you through some of the charts, but we still like the sector. The sector moved big on Viking. Also, last week was Dell. Dell reported a quarter that was just okay. They talked a little bit about what's going on in AI. The stock took off, 30% move. Hewlett Packard did not move at all, really. So we think the correlation between those two companies is very high. Maybe there's a trade there. Is this 1987 or 1999? Well, 2024 may have some similarities between both markets. So a victory lap. I really appreciate all the positive comments we got back last week on Viking's big move. They released data, the stock went up quite a bit. So if you had put $100,000 into Viking, where we bought it for our healthcare strategies at $2.45, and then you sold it where we sold it, you would have profited $2.7 million. So it's mind-boggling. We still have some really good ideas. As we mentioned, we sold Viking at $69. Wasn't the absolute high. Actually, what we did over time is we scaled it out as the stock went up quite a bit. But we made a really nice return on this position. The company released phase 2 data, and it showed results much better than expected. Weight loss of 13% just after 13 weeks. So that's much better than what's currently on the market. The stock responded appropriately, went up quite a bit. The market cap now is roughly $9 billion for Viking. When we invested in it, I forget exactly, $100 million to $200 million market cap is where we invested in it. We thought it was a great story, and it turned out to be much better than we anticipated. So we continue to look for obesity plays, and we think we have a good one in VERU. Again, VERU. This is an obesity play that helps develop or not lose lean muscle mass. So it's really important when you lose weight not to lose that lean muscle mass. So we think this one, as we talked about it last week as well, we think this one has very significant upside. The biotech sector, okay, so it has from the bottom of last year, so the bottom of the market last year, late October, is now up roughly 59% off the bottom. It's just getting started, okay? It broke above the 200-day moving average, which was a technical buy rating, and nicely above 100, a little bit above the $100 level now on that ETF. XBI. So a lot of these companies, when we really first got aggressive about the space, had a lot of cash on the balance sheet, trading below cash. A lot of them are still very well funded. So there's some really good ideas still out there still. Really, really good products in development. And then the large companies still need to replace their pipelines. So they're acquiring companies like crazy, and they're going to continue to do it. So looking at the space longer term, so this is roughly a 12-year chart of the XBI. So it had a really big move 2020 to early 2021. That was up about 250%, that move. And then it gave it all back. And a lot of it had to do with some weak companies that should have never been funded, but also the attitude about the Federal Reserve cutting or raising interest rates aggressively. So that's a big negative for biotech. When the Federal Reserve starts cutting, if they do it aggressively, it's going to be a really big move out of this sector. This might well be the best performing sector if that does occur. So we're still very confident in the prospects of this sector. There's a lot of interesting things that are happening, not only in obesity. Obesity is going to carry this group for a number of years with the really large amounts of revenues that can be generated from this. But Alzheimer's is just around the corner. There's some really interesting drugs that are coming to the market in the next couple of years. So that's really going to add some more fuel to the fire. The stock market, the fundamentals are weakening. So we think the best indicator for the economy and earnings is the ISM index, or the Purchasing Managers Index. So the stock market is currently trading at 21 times earnings. That's high. It's very high, and it's gone up because of the hype around AI and obesity, and the belief that the economy will not fall into recession. But the Federal Reserve the market still believes the Federal Reserve will cut interest rates. So the two don't go hand in hand, but so there's high expectations. The economy not falling in recession, the Federal Reserve cut interest rates. We still think that there's an issue with inflation staying around longer than expected. You really need a recession to wipe it out. But again, the indicator we like, we've talked about this in the past, is the ISM index. It is now negative, so negative growth out of the manufacturing sector for 16 months now. Remember, around 42, we're in a recession, so we're not there yet at 47.8, but it had a pretty significant drop in February versus January. So that's not good for the outlook for earnings for the companies in the S&P 500, unless there's something real specific outside the economy that's driving it. Big insider selling on the markets, really big. So if you look at the first chart, this is the daily sales on the red line, the daily sales by corporate insiders, and the blue line is the daily sales. So it's a number of trades by corporate insiders. So a big differential between sales versus purchases. And typically around bottoms, you see the opposite. You see really big purchases versus sales. Now, what really stands out is the volume of shares being traded, or the dollar amount of shares being traded. Big dollar amounts in terms of shares being sold, very little dollar amounts in shares being purchased. So insider selling historically has not been a great timing mechanism or timing tool, but it does just point out kind of where we are in the market cycle. So we're kind of late in this market cycle in terms of the valuations getting very stretched, and it might give some insight as to what corporate insiders are thinking about the near-term prospects for their stock prices. AI hype. So as we mentioned, Dell reported a quarter. Revenues were down about 11%, so nothing all that spectacular, right? They did mention that their AI products, so these are PCs/servers, grew 40% sequentially in the quarter. But it's a very small amount of their total revenues. So right now the revenues are about 5% for their AI products. And looking out to next year, or this year rather, looking out to this year, the company's expecting about 5% revenue growth. So not great revenue growth. There's an overhang because corporations and individuals are not buying PCs, but the environment is right for that to start picking up. So there's a large install base of PCs. They're all, it's historically old computers now. They all need to be replaced. And we think what will happen is, as AI spreads and really becomes a bigger part of computing, then individuals and corporations will have to upgrade their PCs to drive it. So it's not going to be only in the cloud, but it's going to be also on the PCs, where you're going to do a lot of that computing as well. It'll need faster speeds. So we're thinking that Hewlett-Packard and Dell have correlated highly over time. You can see from the chart, these are highly correlated stock prices. And then Dell takes off. Dell's had a massive move recently. And Hewlett-Packard has kind of just stayed there. So it's flat. Hewlett-Packard's been flat, and Dell's gone up quite a bit. We think there's a catch-up trade here. So this is what you do in the late stages of a market cycle. You find that stock that has not kept up and you buy it. And that's where the return is. But then it typically is not a great stock, so you're going to have to get rid of it at some point. But Dell at 8 times earnings versus Hewlett Packard at 20 times earnings stands out as a nice valuation disparity, and there's an opportunity to trade Hewlett Packard. Okay, so 1987 versus 1999. Well, there's similarities between the two currently. So in 1999, you had tech almost at 40% of the overall weighting in the S&P because of the appreciation. Now, as we mentioned in previous Market in Minutes, if you add that 40, add back everything that is technology related, you're around 40% in the S&P as well. The valuations are similar, okay, to as to then, but they're similar now relative to interest rates. They are both higher in those two periods, but they're similar. We are similar to being overvalued versus bonds now. So we think it's more closely related to 1987, to be really honest with you, in that you see this chart here. So this is 1987. Big move, consolidation, another big move, and then we went into that vicious bear market. We are somewhere around here in terms of the calendar as well, and we're significantly above the 200-day moving average. Back then it was 17% above the 200-day moving average, and we're around 13 or 14. So we're extended. And then the thing I would think about is, using a stop loss if you don't use our services, but using something that, say you break the 200-day or you break the 50-day, get really defensive with your portfolio because it could have a very significant decline. When you think about the S&P at 21 times earnings, where we would feel more comfortable with the valuations and what's normal is around 16 to 17 times earnings. So you could see a quick 20% drop in the markets and not be able to react to it. So you have to be ready for it. We think our tactical strategies have a lot of merit to how people should allocate their money at this point. You need to be able to get out of the way of it, but still get some good upside if it continues to move higher. If you'd like to get a hold of me, go to my website, Patrick Adams CFA, and send me a message saying you'd like to do a call if you're an advisor or an individual investor that has some questions. Or you can call our sales staff at this number here, 874-7487, area code 303, and then talk to our staff, and they'll set up a quick conference call for us to discuss what we do, how we manage money. So thank you very much, and it's been a pleasure doing this video.